Hello, I'm Brian Lucareli, Director of our Private Client Services Group and co-chair of our Family Offices team at Foley and Lardner. And today I'm here with Brett Bellmore, Senior Counsel and a member of our Finance Practice Group. And today we're going to discuss debt financing and options and considerations. Welcome, Brett.
Thank you very much for having me, Brian. As Brian mentioned, my name is Brett Bellmore. I'm a senior counsel here with Foley and Lardner. I'm a member of our finance practice group. I primarily do borrower side debt finance, so representing borrowers and issuers on their credit agreements and facilities, indentures, notes, and other credit management and treasury management services.
Perfect. So let's dive in with the question. So at a basic level, what are the main available types of lenders who provide corporate debt financing that family offices would want to consider?
Yeah, so this is a simplification to try to hone in on what the family offices might want to consider. And at that point, there are really two main kind of categories of lender that one might be looking at. There's diversity within those categories, but the two categories are one on the first hand, banks, traditional banks and lenders, and on the other is private credit, which primarily is to say private equity. So there are some differences between those. These are generalizations, but they, for the most part, will hold true across these categories. So your traditional banks are, well-known names, well-established lenders. Some of the larger ones are, J.P. Morgan, Bank of America, Wells Fargo. Certainly, lenders that you've probably heard of in your private and professional life. On down to smaller ones as well. They typically have more stringent underwriting and credit standards than the alternative of private credit and private equity. That can result for a couple of reasons. One is just that banks are particularly and specifically regulated as banks. And those regulations, those capital requirements, and those kind of restrictions that are meant to protect the financial system can make banks more exacting in their standards of who they're going to approve to lend to and at what amounts. And it can just in general be that they are more risk averse in general than private equity, which might be trying to cut into the traditional lending business, and so in that regard, might be willing to lend to those who banks aren't willing to serve or aren't willing to serve at the amounts that they're looking to receive funding at. On the other hand, banks typically are going to offer the best pricing for those who qualify. Not everyone is going to qualify for that, but if you have an option for a traditional bank loan, and it's in a sufficient amount, usually that's going to be your best pricing all in. That's considering fees, which are usually more reasonable on the bank side. It's considering interest rate. So all in pricing is usually what's going to be the real strong argument for choosing those banks if one qualifies. But again, some people or some borrowers may not qualify, and if they do qualify, they might not qualify for the amount that they're actually seeking, which may be as good as not qualifying. They also may be less flexible on other bespoke terms. That doesn't necessarily extend to banks being more difficult to negotiate with. That generally isn't true. But there are certain things that they expect in their agreements, their well-tread agreements, and if a borrower has a very specific situation, a bank might not agree to get rid of a covenant on a broad category of liens or other indebtedness or that sort of thing. That might be a little more strict in expecting that their agreements are going to have certain aspects in them. On the other hand, you have private credit, private equity. So that's a rapidly growing portion of the corporate debt market. They are a majority of the corporate debt market at this point. There is less standardization than on the bank side, so you have a lot more variety in the types of arrangements that those sorts of lenders may be willing to agree to. And they may be willing to lend to borrowers that traditional banks may not be willing to lend to or not lend to in sufficient amounts. They can also be more flexible at the outset in agreeing to specific uncommon terms. But the rub is, you really have a trade-off between pricing and risk at all levels. So, if a private lender or a bank lender really is taking on additional risk based on the terms, you're probably going to see that reflected in higher pricing, whether that's by fees or interest rate or both. That sort of is a trade-off of trying to get one of those more unique agreements with a private equity lender. But at the same time, if those are terms that are sufficiently important, that may be a trade-off that a borrower is willing to make and to consider. They're also often more open to sort of hybrid arrangements that might have debt and equity components. This presentation and my expertise is focusing on the debt component of that. But things like warrants, convertible debt, stock options, those are all things that can commonly be components of a private equity deal. They may not just be interested in specifically the debt portion, but in an equity ownership of a borrower or in some sort of other role other than just purely a lender role. So if something like that is something that a borrower is looking for, private equity and private credit is kind of what you're trying to broach that with, and where you're more likely to get that sort of an arrangement.
So go ahead.
Yeah, thank you. So one last thing about kind of the macro effects of the market. So as I mentioned, private credit is now a majority of the debt market, but it's more common at the middle and below market level. Typically, if you have a large corporate borrower, it's not in any sort of dire financial straits, it has a strong credit rating, those borrowers are still generally opting for the bank lending, the traditional lending. It's where you get to smaller borrowers, those with less of a credit history or credit problems, those just starting out, those with liquidity issues or high leverage. That's where you see private equity really as the far more common sort of route forward, where those bank lenders might not agree to be involved.
So it sounds like there are certain pros and cons associated with each category of lender, but what should a prospective borrower considering when choosing between the various lenders or types of lenders?
Yeah, so the first thing that the borrower would want to consider in that situation is, what terms are you actually seeking? What's kind of leading you to want this financing? Is it for a bar? Is it, who's the borrower? Is it for a particular entity, or is this, beneficiaries or shareholders trying to monetize, assets to which they might be entitled, equity holdings, that sort of thing, and kind of turn that value into debt that they can actually use on something else? Or is it for corporate purposes? Is it something of that nature? Is there collateral, whether in the form of a business's assets or, say something that might be held in trust, stock interests, equity rights, that sort of thing? And is it something that you're willing and able to pledge? Because whether a loan is secured or not can substantially determine, how much a lender is going to be willing to lend to a borrower. Because it's kind of a guaranteed value that they can potentially get, and thinking, if this debt goes bad, what can I sell? What is my recourse? So that can really have a direct relation to who's willing to lend and how much they're willing to lend. What sort of involvement do you have from trusts? Is there any requirement for a bankruptcy remote structure? And then just kind of the basics. How much do you need? What term? How urgent is it to close quickly? Any other bespoke terms? So that's the kind of first thing to ask yourself is, what terms do I need? That way you know to request them from any lender that you're speaking to, and you can kind of evaluate those proposals against one another. And that leads directly into the next question is, what options are available? So really it's in your interest, if you think you may qualify for both types of lenders, to reach out to multiple lenders of each category. That's really when you as a borrower have the most leverage, is before you've chosen a lender and before you've settled on one specific set term sheet. Because at that point you can play the lenders off against one another. They don't know that they're guaranteed your business. It's just when you can get the best terms, and so it makes the most sense to ask for your full terms up front and have proposals from each of those lenders and be able to choose between them laid out against one another. To some extent, if you don't qualify for a bank loan or one of sufficient size, that decision can partially be made for you. But even if you're just dealing with one category, certainly you may have multiple lender options within that category and still some negotiating leverage through that. Finally, at the last stage, you're really just comparing the negotiated terms. You have a final offer from lender A, lender B, lender C. Stick them in a matrix. We're happy to discuss, and help evaluate and compare those terms against one another. But it makes it very easy to see, where is my best offer? What are the trade-offs that I'm making here? Where's my best pricing? And then just going forward with whichever lender is giving you kind of the best overall deal based on what you're seeking and the reason that you're going for that borrowing.
Well, I appreciate the matrix concept. It helps make things very objective versus subjective. So last question here, Brett. So when should family offices involve Foley or their own external counsel in the process to ensure they choose the appropriate debt financing structure, lender, and terms?
So in a word, early. Ideally, before you finalize that term sheet and before you select that lender, again, that's when you have the most leverage. That's when we can be the most value add. We can suggest at that point terms that we've seen other similarly situated borrowers get. We can help you kind of evaluate, terms against one another, let you know track records of lenders if they have different reputations. It's just where we can be the most helpful in getting you to where you want to be, where you want to get, excuse me. That's a matter of incorporating best practices. It's a matter of avoiding any sort of pitfalls, but it's also a matter of just kind of involving everybody who needs to be involved. So, it's not necessarily just our finance team or your counsel's finance team that needs to be involved, but potentially your corporate advisors, if there's any sort of equity component or restructuring, potentially tax advisors in almost all situations where, you're potentially trying to structure debt a particular way or meet some other concern of the business or the family. Or the office. So really it's a matter of kind of involving all of those stakeholders, and that's something that we and the family office can help you coordinate.
Good. Well, Brett, I want to thank you for your professional insights today, and I want to thank all of you for watching our presentation. For more information, please visit us at foley.com under Family Offices. Thank you.